Hey, good morning, everybody. Dale here with TerraVest Capital Partners with a quick weekend update. There was a news item this week that caught my attention as a debt investor, and I simply wanted to share it to you because I think it adds context to this whole idea of distressed debt and what we're watching for in investing in distressed debt. So anybody that watches the commercial real estate market is certainly aware that there's a lot of commercial debt with the lenders right now that needs to be refinanced or coming up on maturity. Now, specifically within the multifamily space, I got some numbers up here on the wall that are going to make sense when I run through them. So specific to multifamily debt that is currently sitting with the lenders, there's $650 billion worth of multifamily debt that's coming up to maturity between now, October 27th, 2024, and the end of 2026. There's $650 billion that's going to have to be dealt with somehow. Will the environment magically improve to where this debt will start, where refinancing will become easier? Nobody really knows. But the news item that jumped out to me this week is that I'm not the only one that's seeing the opportunity that's beginning to present itself. $500 million is the money, the fund that's been created by PGIM, and another partner of theirs, CityMark, to create a fund to buy multifamily debt from the lenders. So they just announced last week, or within this last week, that they set up a fund for $500 million to buy that debt from my multifamily debt from the banks, which is great to see that they're basically confirming the fact that there's going to be opportunity in multifamily debt. Now, what's the other number I have here? $2.89 billion. So as a distressed debt investor, that's a number that jumped out to me. So of the $650 billion of multifamily debt that's coming up on maturity between now and the end of 2026, as of the second quarter of this year, third quarter numbers don't seem to be out yet from the banks in their FDIC filings, but based in the second quarter FDIC filings from the bank, $2.89 billion of that $650 billion is non-performing, or what's called non-accrual debt, meaning the loans are simply not being paid. Those are the kind of opportunities, and that's the kind of inventory from the banks that we're watching for, that I'm watching for, that we can get at significant discounts that create a great opportunity. Matter of fact, I'm going to call it a generational opportunity that's beginning to present itself between now and over the course of the next 2 or 3 years. I really do believe it's going to be a generational opportunity. The funny thing about generational opportunities, especially in real estate, they're usually talked about in hindsight. People talk about the 2008 great financial crisis and the opportunities it created in 2009, 2010, 2011, but they talk about it in past tense. I wish I had. If I'd only known, I wish I had taken action or something like that. I'm trying to tell you about this stuff before, as the opportunity is beginning to present itself. So you can't say I didn't know about that in 2030 or whatever it might be. It's coming, folks. I think there's a great generational opportunity. So to that point, as I always say, if you are the holder of a rollover IRA or a self-directed IRA and you're just sitting there with cash, there is an opportunity to invest in distressed real estate debt out of that self-directed IRA. If you have questions about it, just reach out to me on LinkedIn. I'll be happy to talk to you about it, and I'll see you in the next video.